Rahul Chadha then on the show with us. Rahul, hi, good morning. We're all smiles. How about you? For the last 2 days, FIIs have been big buyers and a big figure coming in yesterday as well. You think Budget 2021 has really called a big re-rating moment for India?
Yeah, clearly, I think it's a positive budget. And if you look at the backdrop of what's been done by government over the last 12 months in terms of these PLI schemes, the labor reforms, everything was to get economy on the growth path. And as we saw the active cases recede, as we saw a number of daily deaths received, economy normalizing, clearly FIIs were positive on India. The global backdrop is for a strong recovery. On top of that, I think this budget gives the much needed escape velocity which the economy was struggling for the last 7, 8 years. So I think it gets the virtuous cycle of investments and again consumption pickup subsequent to that back in the economy. So that's where we're very bullish again on India, and I think this budget just reinforces our positive case for India.
Indeed, it is. Rahul, we've been talking about what the budget has done, what the budget could do. I mean, yesterday itself, we made it to that 21st January top, from which the market then saw a 6-day cool off. Materially, does it make the bull case for India equities stronger? Or do you think the markets at some point will settle down with the frenzy and be like, you know what, the budget also has inflationary implications, and eventually the central bank would have to perhaps curb on the low interest rate trajectory, and that's not going to spell good news for markets?
Okay, so multiple points in this kind of a question. Basically, first, markets are going to look at economic recovery. Look, this is something we've discussed for the last 3 to 4 years. In every market, we had two different markets. One was the consumption part of the story, which was expensive, which was all these names on peak margins. I think those names will take a breather here. We've already seen the likes of Hindustan Unilever come and talk about inflation impacting margins, etc. Whereas the investment cycle link, the banks, particularly the PSU banks, were underowned. Some of these corporate banks were underowned. There was nothing much happening in the investment cycle. I think that kind of picks the baton, and that leads the market further. Inflation is a concern, but I think it's going to be more of a third or a fourth quarter concern, or more of a 2022 concern. But right now, it's really the beginning of, again, this positive investment cycle. And what the government has done, or what the RBI has done, is similar to what Fed's done in US. I mean, the Monetary Authority in US also are okay with negative real interest rates, because they want animal spirits to come back. They want investment cycle to pick up. The problem in the world for last 10 years was China had overinvested, rest of the world had underinvested. I think that's correcting, and that's good news for active stock pickers like us.
When we spoke last, you were overweight India. Are you tempted to increase that overweight stance to extremely overweight? I mean, you can do it, but do you see the proposition of India being so strong post-budget?
Okay, so the weights have remained barely at a similar level. Against MSCI Asia, India weight of 9%, we are running anywhere between 23-25%. So that's a significant overweight. Beyond that, obviously, we also have risk teams who come in. But then what we've done is we've been taking money off the expensive consumer discretionary names. We've been taking money off some of the consumer staple names which have done well, names which are at peak cycle profitability, and putting that in corporate banks, putting that in industrials. And I think that's where the leadership in the market changes. So clearly the sense we are getting is, and this is something we've discussed over the last 6 months, is there is a regime shift which is happening globally. Your monetary and fiscal policies are getting merged. Governments world over, post all these protests which have happened, realize that they need to get growth back. They need to come out of this growth rut. And I think the Indian budget is also a reaffirmation of same, that governments are willing to look through cycle, willing to be happy with higher fiscal deficits in the interim to get out of this growth rut. And I think that's very positive from equity market perspective.
Rahul, it's a very interesting way of looking at consumer, durables, that they are or consumer staples rather, that they are at peak cycle profitability. But if I frankly look at numbers from Asian Paints, volume growth is still there. All FMCG companies have given very strong volume growth. So if the investment cycle is going to pick up, I'm sure it will have another multiplier effect on the consumption cycle. The per capita will start increasing. So is it too early to just look at valuations as a barometer and start moving to other sectors?
Okay, so valuations probably would not matter for early cyclical plays, and that's where would be the financial, that would be industrials. For some of these consumer discretionary names which have done exceptionally well and are sitting at 23-24% margin, obviously they're going to attract competition. And over the next couple of quarters, we'll see managements take a call that we're willing to sacrifice margins to make sure that we don't have strong competition come in, basically. And I think that's what market is going to look at. So what market will trade is the relative earnings growth across sectors. What market will trade is relative EBITDA growth across sectors. And I think that's where these sectors would lag. And let's not forget, having done well for last 10 years, these sectors are very well owned. You look at the market caps, these market caps are huge, basically. So I think that's where market smarts in its own way. It will go towards things which were under-owned, which is the financials, which is the commodities, materials, and industrials.
Before budget, everybody was of the view, go digital, go tech, go digital. Some were saying both. Now suddenly everybody is saying go cyclicals, go industrials. What will happen to the digital proposition, IT, and such other sectors?
Okay, so tech remains an integral part of our portfolios. We've discussed this in past, and clearly we prefer tech over healthcare because look, the tech spends have gone mainstream. The problem with the Indian IT companies was the legacy business was degrowing. So despite digital revenues growing at 30-40%, the overall growth rates were barely 5 to 8%. I think they are able to break out of this 5 to 8% band and go toward more towards 10 to 14%. And these are high ROE companies. And with the structured visibility of these digital spends, I think these companies will continue to be good compounders. I think people are talking financials because, look, financials are not that well owned, or the overweights are not as high as used to be 2 years back. So that's where the alpha is there. And they've also lagged in last 12 months. But tech are steady structural return stories of anywhere between 15 to 20% annual returns.
What about the P multiples for tech? What is the right way of looking at the P multiples there? 30 times for TCS, 21, 22 times for Infosys. In today's environment, when these companies are doing a lot of buybacks and double-digit growth is back for 2 years at least, or maybe 2.5 years, what is the right way of looking at this sector?
I think 25 to 30 times, 12 to 18 months forward is a good multiple. Look, let's also understand what's happened is Indian markets have got a lot of money in last 3 to 4 months. So as we see growth visibility come in other sectors, some of the money may move out of IT to other sectors because, like the way I said, market trades the relative earnings across sectors. But fair to say at 25 times, 12 months forward, one is not going to lose money and the returns are going to be in line with the earnings growth.
Okay. On the banks, Rahul, and of course you mentioned the corporate banks, but tell us, if we probe into this a little bit more in detail, the kind of opportunity you see, given the kind of action that we've seen now in the last few months. We've definitely seen banks lagging. Clearly, after this budget, they're going to be back in focus. We've already got all those re-ratings coming in. But really, how much strength do you see in this? Where's the opportunity? How confident are you of seeing that revival in growth and just seeing the implications on the sector going forward?
The first and foremost thing which we're watching closely for cyclicals is inflation. So globally, if you see inflation break-evens have moved up, and look, there is a very strange thing which happens with inflation. As people believe that it's coming kind of a quarters are going to be more inflationary, people start restocking. So you're seeing evidence of restocking happen globally across commodities. I mean, you've seen close to about $1.5 trillion which has moved into commodities, and as that restocking plays up, you see credit demand picking up. So you read the statements which are coming from HDFC, your October, November, December monthly dispersals are touching new highs, are picking up significantly. Across the board, there is a revival of credit demand. So again, what is going to happen in financials over 2 years is going to be credit demand picks up, spreads improve a little bit, you have write-backs which come through, and that's where the virtuous cycle plays out, basically. So which is why we are really at the year one of the cycle. I think where we'll be worried about kind of a financials would be that come 2022, there's a significant pickup in inflation. Politicians, central bank governors, everybody is worried about inflation impacting common person, and that's where they try to slow down the growth.
Okay, fair enough. And so clearly cyclicals is the way to go. And within that basket, I mean, you've mentioned the commodities, you mentioned the industrials. I mean, is there a pecking order here, or you'd look at leaders within each of the segments?
So the way we're playing this is exactly like the way you said. You stick with the leaders because look, we are in early stage of recovery. Should another variant of COVID comes, which is very contagious and cannot be handled by vaccines, etc., and economies are in a semi-shut mode, obviously you can see some of these gains being given away. So which is where it is important to be with the leaders in the cyclical basket, be with strong balance sheets, etc. That gives some bit of a downside protection also. And as we go through, let's say, most of these vaccination programs, as we go through a buildup of a herd immunity over next couple of quarters, one may move down the curve. But at this point of time, I think it's most prudent to stay with the leaders in the cyclical pack.
Okay. Besides what you've already talked about, that cyclicals as well as IT and banks, Rahul, are there newer opportunities to bet on in the market, or would you say ride on the same horses, IT, pharma are your best bets, and they're going to continue to be the long-haul growth stories?
Okay. So I think we've got a lot of IPOs which are lined up for this year, more so in the tech space. So those are going to be interesting entry opportunities. See, right now sentiment is a bit hot for them. Valuations may not be attractive. But look, if market moves towards this cyclical sectors, you may get some of these good structural stories at attractive valuations over the next 12 to 18 months. So that's something one would like to work on. Also, again, though we've discussed about some of these industrials, etc., but a lot of work's been done with on the top names. So we'll take this opportunity to go a bit kind of down the curve and do at least work on the good second-tier companies, so that as one gets more confidence on the recovery, you can increase exposure to them.
Would autos be a part of your favorite list? Because what one is seeing is a massive recovery in not just the stock prices, but even the monthly sales data seems to be indicating that there is a massive revival in autos, and they're getting pretty near to the pre-COVID levels, if not already there. And, you know, the interesting thing is that the revival is not just in auto, but one can see even ancillaries, your tire manufacturers, battery makers, they're all holding up very smartly.
Yeah, no, I think clearly autos would be a good way to play this. If you look at late 19, early 20, auto cycles being impacted, whether it was the new emission norms which had come through, COVID, etc. So there is a pent-up demand and which is going to come through. And what we've seen is with these companies right now, they're a bit unsure of taking price hikes, but as they get more confident on the recovery, they will take these price hikes and would be able to defend their margins. So autos is a good way to play. And as government kind of extends the PLI scheme for autos, we may see some of these companies which have sizable volume coming from exports also benefit because of that.
Rahul, a point which we were discussing just before we had you on the channel was Indian markets were trading at a strong P multiple based on historical averages and on relative case. And markets were factoring in a earnings recovery. Post-budget, do you think now there is strong scope for P expansion and both earning expansion, because the budget dynamics now will automatically change FY 22, 23, even 24 earning projections, because now you know what is coming in terms of a multiplier effect, which will force everybody to relook at the projections.
Okay. So what happens typically in a mid-cycle is, which is the year two of the recovery, you'll see earnings come through, but multiples derate basically. P multiples derate because multiples expanded in the year first. What happens post this budget and whatever government's done over the last 12 months is if the economy gets the escape velocity, as you see the virtuous cycle play up, and again, we were at the trough of the cycle. We've not seen any investments for last 5-7 years. If that virtuous cycle play up, come through actually, and the nominal GDP moves out of this 7 to 10% band to anywhere around, let's say, 13 to 17, 18% band, that's where you'll see multiples expand. So right now, market will watch for the signs of this pickup, of this acceleration of nominal GDP. But those multiples can very well expand if the nominal GDP goes anywhere between 13 to 18%. And if everything goes right with this huge pent-up demand which is there, with the investment cycle picking up, with all these FDIs picking up, I think there's a fair bit of a chance that we can get significant acceleration of nominal GDP over the next 2-3 years. In that case, the multiples will definitely expand.